Good morning, good afternoon, and good day, depends where you are. Welcome to the 25th episode of BioVerse, where science sparks business in medicines. My name is Leon Tang. I'm the recurrent host, and today is my great pleasure to have two very knowledgeable experts in royalty investment, both from the investor side and from the biotech biopharma side, join me today. For those who are dialing the first time BioVerse, let me share with you a little bit background who we are. So you are going to be on the same speed as most of the audience, I can say, are recurrent attendee of our events. All right, so I'm sharing my slides real quick. Like I said, today we're going to talk about the rise of royalty investment in biotech. And this is what BioVerse really came from. The webinar where science sparks business and medicines. This is a webinar co-produced by three US-based nonprofit. The first one is ourselves in Science We Trust Community. It's a New Jersey-based nonprofit. And BioVerse, as you can see here, is our flagship program. And in addition to that, we also have Asian Biotech is working in a bar, weekly newsletter with actually right now over 4,500 subscribers. And then second organizer of this event is really SAPA GP, Sino America Pharmaceutical Professionals Association, Gui Philly chapter. They've been around for almost 30 years. Actually, SAPA by itself is over 30 years. Gui Philly chapters really cover thousands of members in pharma, biotech, and investment communities. The last, definitely not the least, is a BioSpark, which is a Boston-based biotech and R&D focused nonprofit, and has been growing really fast. Actually, they're a little bit older than us. In Science We Trust Community is only like a couple years old, and they are approaching 7 years old. BioSpark. That's about BioSpark, and SAPA GP and ourselves and BioVerse. Full disclosure, this is really a discussion. This is not an investment suggestion, so don't take that for your investment decision. And this is also only represent a speaker's opinion, not necessarily for their own organizations. If you have any questions, please reach out to us. Now let's get into today's speaker. It's really my great pleasure and a lot of face-to-face conversation with both speakers, but I will let them introduce themselves, their company, and their focus. Probably start with Mr. Clark Futch. Clark.
Thanks, Leon. Appreciate the invitation. Happy to be here. I'm Clark Futch. I'm the founder and CEO of Healthcare Royalty Partners. We are now part of KKR as of this summer. And our business is really about acquiring royalty streams, primarily in approved pharmaceutical products globally. We have over 50 products in our portfolio, over 30 different therapeutic categories. So I've been investing in the healthcare royalty space for 24 years now. Have seen quite the growth. We'll talk about some of that today, from very, very small to much more mainstream today, much larger, and a real viable alternative for the emerging biopharma companies.
Fantastic. Alex?
Hi, my name is Alex Cogdill. Wonderful to be a part of the episode today. Thank you for the invitation. I am currently the head of strategic initiatives at Daiichi Sankyo. I've been with the company for about 3.5 years. I'm a classically trained immunologist, but I've been a part of BD for the past almost 8 years. And I've spent a number of years bringing drugs to market. I was part of the team that commercialized the first CAR T product. I spent a number of years improving immune checkpoint blockade alongside Nobel laureate Jim Allison. And I was part of Imuni, which is a company that hit its unicorn status. And now I've been part of a wonderful and global leading oncology company here with Daiichi Sankyo, and part of some world-leading billion-dollar deals. And it's especially exciting to talk about this particular topic, as it is a growing, exciting investment opportunity for biotech and for pharma, as we've seen in the last few weeks with some big announcements in the category. So thank you for having me. Excited to have the conversation.
Fantastic. So it's really my great honor to have both of you join me today. To be honest, I'm pretty, I would say, naive with the royalty investment in biotech and the pharmaceutical industry, but I try to pick up the speed so I can be a decent moderator. So I want to set the stage for people in the audience who probably also not very familiar with the royalty investment. So based on the news there, we just published. Obviously, there's two recent major investment. One is actually announced last week. People, if you recall, Blackstone invested $700 million to support late-stage development of ADC from Merck, which was licensed from China Biotech Kelun. And earlier, a few months, few months earlier, there was another investment also by, I believe, by Royalty Pharma into the DLL3 T-cell engager by B1 Medicines. So that's two kind of two among the largest investment in recent years. And also based on analysis of this year, actually the annualized expectation investment in Royalty Pharma into the pharmaceutical industry is over $7 billion. If that's true, going to be probably the largest investment per year in the past 5 years. And the trend is very clear. The investment has been going up, and the company who are receiving the investment gradually expand into the biotech, which is our focus today. With that being the background, so obviously I'm not a really expert. I'm just enough of a moderator. I'll let Clark and Alex to give audience a kind of a quick introduction. What is really royalty investment? How does this differentiate and hold advantage over other typical investment in biotech industry? Probably Clark, you want to start since you have been doing this for such a long time?
Sure. No, happy to. So, just at its core, royalty investing really involves monetizing or acquiring royalties either in products that are still in development. You mentioned one of those, Leon, or products that have already been approved by the regulatory authorities and launched and on the market. And it's really a way for the innovator of the technology to monetize some or all of that future cash flow stream and pull forward that capital today, typically to reinvest in additional clinical development, additional product acquisitions, product launches, all the normal sources and uses of capital of emerging biotech companies. So, you mentioned the growth. There's been a tremendous amount of growth, really driven by tremendous innovation in the last couple decades. So a lot of new development, a lot of that development, at least the early stages of that development, happens in these emerging biopharma companies. Subsequently, the products are sold or licensed to larger pharma, and royalty, assuming the product's approved and launched, is paid back to the emerging biopharma companies. So the way we think about it is really that monetizing the royalty is just another tool in the capital raising toolbox of the emerging biopharma. There's always the classic raising of equity, maybe out licensing and other territories for an upfront capital and some ongoing royalties, maybe venture debt. And then adding this tool to the toolbox really just provides another way for the emerging biopharma to raise capital and to redeploy that capital into other exciting new potential projects. So at the core, that's it. And the advantages, in addition to being, again, another option, is it's non-equity. You're not selling shares in the company. You're selling a part of your future cash flow stream. And the way we think about it is really as being a complement to these other financing alternatives that have been around for a long time. And so when it comes to capital and biotechs, more is better. More money's better, more options are better. And I think it kind of helps to spin up the flywheel of innovation and capital raising in biopharma.
Yeah, I think Clark makes such an excellent point. In more is better, and the two things, right, you want to you shy away from both in biotech and pharma is you don't want to give away equity and you don't want debt. And so this type of structure is allowing that there's something in between, and then you have flexibility that allows you to move that capital towards, more is more. And so I think that definition is wonderful in that it captures those three things really, really well. That it provides flexibility and you're not giving up equity and you're not having to take on debt. And so that's, I think, why it's become so attractive to biotech and to pharma.
Great opening. Oh, by the way, I saw there's already a question coming. I just want put a reminder to the audience. If you do have a question, please put in the Q&A box in the bottom of your screen. And also, because this is some compliance involved, please do include your name and your company. And now we're gonna select a question. By the end of all the discussion, we're gonna put them together in a Q&A session for a few minutes. So great, that's fantastic. So probably now we understand what the royalty rate about. Looks like there's some advantage compared to traditional equity and debt and other financial tool, capital raising tool. So the second question is, like I mentioned in the beginning, opening, the amount of investment has going up. Question to both of you, why it's gaining popularity, right? What's unique, both in the nature of the royalty investment as well as the current macro environment, the industry environment, make a royalty investment so popular?
Well, I'm sure we both have maybe unique answers from this. Perhaps I can give like a pharma answer. I think one is for the reasons Clark mentioned, which is that and we reinforce, which is that you're not having to give up equity or take on debt in this environment, but that in having innovation and also having what is now, I think, pharma recognizing that you have very unique partners now. You have very flexible, capable operating partners. You don't have in this late stage sort of phase 3, kind of royalty partners who are bringing in, very large check sizes, but not just a check, right? These royalty partners who are coming in saying, we're going to take in balanced risk with you. So they're taking on risk in a large check size and helping you bridge, right, that risk in a phase 3 setting with your asset, right? And they're coming in and they're saying, let's take on this shared risk. And in that shared risk, we're both getting a gain at the end of the day. Should this hit, right? Should this be successful? We're both going to win, right? And by doing that and having that bridge to success, that opens up an option that I don't think was necessarily attractive maybe 5, 10, 7 years ago. And now I think pharmacies as like in this funding environment as an option that is very positive and unique. And so we see companies like, Merck and others who are signing these deals with, and saying it's not just a check to us anymore. We want a partner that is going to help us see this through, that's going to operate with us in a regulatory environment, in a manufacturing environment, in a clinical environment, and help us raise the bar in seeing this clinical success all the way through. And in doing so is going to share in that success. So I think we're going to see more of it, not just in pharma, but in biotech, because they don't want diluted capital and they want to be able to move this through in a way that's not affecting the P&L. But I would love also Clark's take.
Sure. All of that is definitely true, particularly as it relates to big pharma doing off-balance sheet clinical trial funding. I think I would say, just stepping back a little bit, to explain the rise of royalty investing, which has taken some time. It did not happen overnight. There's a lot of education required. As I like to say, if you go back 20 years, it was a missionary sale. It was very rare for this to happen and unfamiliar. And so, that's taken some time. And what we're seeing now is really an acceleration of a trend line. But if you go back to the fundamentals, there's more raw material, right? The innovation that's happened. And what I mean by raw material is there's been innovation, those products are coming through the pipeline or now launched onto the market, and there's just more license agreements out there. And almost all of these license agreements have a royalty attached to them. That's how economics are transferred in the pharma industry between The marketers and the innovators is almost always through a royalty stream. And so you just have a lot more, again, in simple terms, raw material that's available to be bought. So that's number one. Number two is increasing capital needs. I was looking at some statistics recently, and the cost to get a product through the regulatory approval process, including the clinical trials and including the ones that do not succeed, right? So their successes and their failures is well over $2 billion today per product, up from $1 billion a decade ago. So more raw material, um, uh, larger need for capital. And the third is Alex, in part what you talked about, which is more familiarity with royalties, and success begets success. And so you've had, again, a little bit of a flywheel effect, I'd say really in the last 2, 3, 4 years, where you see an accelerating trend line in terms of capital raised. All that being said, it's still a fraction of the capital raised in biopharma. So even at the levels, Leon, that you mentioned, it's, dependent upon the numbers, 5 to 10% of all the capital raised in biopharma between licensing deals and equity deals and converts and venture debt and things of that sort. So while it's growing rapidly, it's still a small piece of a very big capital raising pie. And so I think there's still a lot of room to run in that respect.
Clark,
Yeah,
it's such an
probably.
interesting perspective. Do you feel due to like the education and the kind of flywheel effect that's continued, do you feel that that will continue to expand given the flexibility that's available in the deal making process in this investment structure? Or do you feel there'll be any shift in other deal structures like within the financing space? Or do you really feel like there's momentum here and it will continue?
I believe there's momentum and I believe it will continue.
I agree.
The
Yeah.
rate of growth could change, over
Right.
time. But if you just look at, again, the raw materials growing, the need for capital is growing. This is going to be an option. And when we talk to management teams and boards, we talk about every time you go out to do a capital raising may not be the right time for royalty financing. But at some point in your corporate financing history, it will be the right time.
Right.
It will be the right time. And so the addressable market is growing. So there's a lot
Yes.
of tailwinds behind that. And so, and certainly equity markets the last month or two have been pretty good, right? It's opened up a little bit, but for the
Mhm.
first, I don't know, 8 months of the
Yeah.
year, it was,
Right.
thermonuclear winter, right? So,
Yeah.
so that window
Right.
sometimes opens and closes. And the thing about, I mean, you know this, Alex, you live it every
Right.
day. These are long-term business plans. It takes
Yes.
years to develop the products, to run the clinical trials,
Right.
even to go through the regulatory process around the world. So you have long-term business plans, lots of capital required.
Right.
So, at a certain point in time, this will be a good option,
Right.
whether it's big pharma doing a clinical trial funding of some, they have budget constraints and they have P&L constraints, but they have really good opportunity, or whether it's an emerging biopharma company that's receiving a royalty. We actually have
Exactly.
a royalty from Daiichi. Thank you.
Yeah.
Um, Receiving a royalty from large pharma and doesn't want to wait 10 years to collect,
Exactly.
a bit at a time,
Right.
needs a lump of capital today to launch
Right.
the product or do whatever.
Right. It's such an excellent point too, because there is a large strategy around, right, both on both of our sides, right? There's a side for you, I imagine, that is very much considering like who are we approaching, right? This is not just an inbound business. You're not just saying I'm taking whatever shot on goal I can get. You're saying where do I go and have the conversation? This is the asset I want to see through that success. And to the same token, we're saying which asset do we want to get funding? Do we want to take a royalty deal on? right? And you want to hope that those things match up, right? Because you don't necessarily want to give ground. You don't want to give like on a back end a deal with every asset because you're not necessarily thinking that's the game you want to play. But there's a portfolio prioritization on the pharma side, and I'm sure to your end, the same kind of conversation because inbound is happening all the time, right, for us as well. But you're thinking that's not the way we're thinking about our early innovation. And I'm imagining there's the same type of prioritization happening on your end.
Totally accurate. Totally accurate. It is about prioritization. And if you're the pharma company,
Right.
it's what are the marginal economics? If I
Okay.
can move this product, to the next stage or get it into a new geography, maybe I wasn't in before. What are the marginal economics? What's the cost to me to do that? What kind of capacity do I have on my P&L?
Yeah.
And if there's a gap, can I close that gap
Right.
with a capital solution?
Right.
Same thing with emerging biopharma that are saying, I've got this pipeline of stuff. It's really interesting. It's really exciting. We've made progress, but we need capital to fund that. And what are my
Right.
sources of capital? How do
Right.
I do that? But you're absolutely right in terms of prioritization and targeting. I mean, we have a list. We call it our top 100 list
Right.
of assets and products that we really like. We've done
Right.
some research and are proactively out there calling
Right.
on these companies every day. We have an office in San Francisco, Boston, London, New York. So, um, uh, you know, that's really a fundamental kind of business development exercise of targeting and prioritizing and moving things through kind of the classic funnel of
Yeah.
an asset,
Right.
willing partner on the other side, and is it a reasonable economic deal for
Right.
both?
Right. It's such an interesting thing how much it actually mirrors like exactly the way we're rank ordering and like funneling on our side. And so it's funny how when you see these deals announced, you're like, oh, okay, they matched, right? They kind of matched up in this
Yeah.
way. Especially given like, and I think this is like maybe Leon matches up to kind of the conversations and questions that I think often get brought up in these contexts. But I'm also so curious how these deals are flexible. And I think that's why they're so attractive to biotech and pharma, and it's, particularly to like where I sit. I think the flexibility in some of the regional rights is what is attractive as well, because often what I think is interesting is it's not necessarily like where these drugs are made, but like where the money is going to be made. And so when you think about regional rights, you think about like, especially Asia, right? We see so much innovation happening here, but it's not necessarily like the money is going to be made there, right? It's maybe about ex-Asia rights, but I maybe am not as well versed in this category. So like Clark, I'm super interested. Like when you think about the flexibility of those regional rights, how do you determine with the company when you're talking about these deals? Like how do you think about that flexibility as it serves both parties? Like how is that flexibility as like a win-win scenario for both the pharma and for the royalty partner?
Yeah, it's a great question, Alex, and something we spend a lot of time thinking about, talking to potential counterparties about. Of course, it starts with if I'm an emerging biopharma and I've innovated a product,
Right.
um, where have I out licensed it to? Maybe I've retained, which you see a lot of
Okay.
times. I want to retain U.S. rights. Maybe it's a U.S. based company. I've retained U.S. rights. I've out licensed rights in Japan, in Europe, in China, in the rest of the world. And so, you can slice and dice these license agreements, and you can buy all of the other territories. You could just, we own 5 or 6 products that are only sold in Japan. We only have the Japanese royalties.
Okay.
We're pretty common these days, right? US
Right.
companies, Europe companies, they need a Japanese partner. They almost all out license to you and your peers, and they're not going to set up a clinical and marketing organization in Japan ever.
Right.
So it really is about what do they own, right? What rights do they own? Where are they receiving royalties? And then it is a little bit, to your point, of follow the money, right?
Ah,
It's follow the money. And of course, the big markets are the US, Europe, Japan, China. Increasingly, the domestic market is becoming larger. But I think what's more interesting for us today in China is technology. You mentioned one deal, Leon, technology that's coming out of China and now being licensed by global pharmaceutical companies. So there's some interesting things going on in China, acceleration in development. It used to be it's either cheaper, faster, or better, right? And you could pick two of three. Now what we're seeing out of China is all three: cheaper, faster, and as good as, maybe not better, but as good as other technology. So anyway, long-winded answer to a very short question, but it's about the counterparty. It's about what rights do they own, and also somewhat how much are they looking to raise. Maybe they want to sell the European rights, keep Asia, for example,
ah,
and then maybe 2 or 3, 4 years down the road, they'll sell the Asian rights.
ah,
So a little bit is how much is the company looking to raise and what's the value of the royalty in that particular geography, and does that meet the need? Or sometimes they need as much capital as they want as they can raise today, and they'll sell, global rights.
that makes so much sense. Yeah, that's great.
And I do think Alex, I do think it is similar, except kind of the other side of the coin of what you're doing in pharma, right? In
Right,
your business and corporate development
right,
activity. And so if you're just looking at diligence, sort of the process we go through is kind of very similar that what you would do as a pharma company. You're looking at what are the patents, right? What are the
right.
globally? What
Yeah,
are the safety and regulatory issues? How about
exactly.
manufacturing? Can you scale manufacturing? Is there a second
Right,
source supplier? All of those things. What's the label look like, right?
exactly.
Uh,
Right. It's very mirroring in its nature, which is when you start to when you start to talk about it in this way, it makes total sense that when you see this like education curve happen, there's like a hockey stick of adoption that you start to go like, oh, this model makes perfect sense for pharma. And now you start to see where like, yeah, let's do this. Like this is a total flexible adoption in terms of understanding.
Yeah, and I think it's again, I said it before, success begets success. So
Exactly.
you do
Right.
something and then the management team, the company gets sold,
Right.
and then they show up 2 years later at another company and they said, oh, well, we really, we had a
Yeah.
successful outcome 5 years ago and we need to raise capital,
Right.
and what are the options? So what we're seeing again, sort of this flywheel effect
Yep.
of maybe not quite a hockey stick, but
Right. But like,
hockey
yeah,
stick
adoption curve. Right.
of activity and capital
Right.
raise.
Right.
Yeah, perfect. I guess you guys, the conversation is so natural already address the second question, the part of the third and the fourth question already. So probably I can still combine them together. If you can do a little bit comparison, like pros and cons of this royalty investment versus the equity investment in biotech, right, which is probably most common, contribute to majority of the capital raise. What would you say?
So I think it's different if you're in Alex's seat and you're in a big pharma company, right? Because they're typically not selling equity. Um, they might raise debt, right? You want to fund something, you call up the treasurer and say, send me more money.
Yeah.
Within your budget constraints is
Right.
probably the constraint there. If you're a emerging biopharma company, of course, there are lots of those, 3,000 of those out there. Um, there are various options. And one thing I mentioned earlier, but it's worth just re-emphasizing is I think the complementary nature. I just saw a deal announced, I don't know, a couple weeks ago where the company announced a couple $100 million royalty deal. And then I think less than a week later, a couple $100 million equity deal. So again, go back to the macro themes, increasing
Mhm.
capital needs, right? More raw material, increasing capital needs. How do we fill that gap? And so what we're seeing is, and
Mm.
I think you're right, Leon, if you went back 5 years, it was do we sell equity or do we do a royalty? Now it's more of what's our medium term, and medium term, I mean in the next 12 to 36 month financing plan, and how do we fill that? So we're seeing a lot more, again, complementary financing strategies where it's a cafeteria menu and they're picking off various parts at the right time. And if you're a biotech company and you can raise equity at a reasonable price, you should do that, right? You should do that. The job of the CFO of a
Mm.
biotech company is not to run out of money. So if the market's available and you've announced
Mm.
some phase 3 data, it's positive and the stock goes up, you should absolutely tap the equity markets. That's actually, by the way, gotten more sophisticated as well. You have ATMs, at the market, these at the market facilities, which 10 years ago, very few people did. And today, if you don't have a facility, it's unusual, right? So you've got ATM capabilities, you've got your regular way follow-on equity offering capabilities. Maybe you do a convertible note. That market's pretty hot today, meaning attractive for issuers. So there's equity options, and more sophisticated than we were, 10 years ago for sure. So if you can raise equity, you should. But there are capital needs, and what we see a lot of times for a product gets phase 3 data, it's positive, stock goes up, they issue equity, which is good, but it's not enough, right? If you're an emerging biopharma company, you're going to launch the product yourself. Let's say you're an orphan disease company and you don't need 5,000 primary care reps, you need like 10 specialists in some kind of, gene therapy or specialized type of product. So you're going to launch yourself. There's not a lot of news that comes out over the next couple of years. And what we hear from, again, management teams and boards is there's sort of this
Right.
this this valley that we're in for a couple of years where there's not a lot of catalyst for the stock price. And so the stock kind of, depends on what's going on in the macro markets, but maybe is kind of treading along. And so that's a good opportunity for us to help fund around approvals and launches until they get some traction and show, what the product can do. And then hopefully the stock price catches up to the operational success. So it sort of depends on the circumstances. But again, the idea of more tools in the toolbox using complementary forms of capital raising, that's really, I think, that's going to be, we're a decade into that, but that's a multi-decade trend that we're seeing driven globally by more
Mm-hmm.
innovation, more products, and
Mm-hmm.
more need for capital solutions.
Yeah, I guess we just go through the first few questions really quick already. So probably another little bit nitty-gritty detail, technical issue. What are the key regulatory, tax, and structural consideration when you do like a royalty investment? How does this compare to, let's say, debt or equity? Probably this time we'll start with Alex. When you said like, big pharma, like you guys love this, what kind of advantage when you kind of take a royalty deals compared to other, let's say, debt in your case, right? Um,
Oh, well, I mean, I'm not a tax specialist here, but and I think Clark touched on this. I think from where I sit, obviously our preferred method is to not take on debt, and we don't want to give up equity, right, as a pharma. So when we want to you know, we're always looking at a budget, right? So we're always and funny enough, I think most pharmas, I don't think this is like a Daiichi Sankyo, and I've talked to many a friend in pharma, and we always say the same thing. No matter how much success our drugs are having, our billion-dollar drugs, we always wish we had more budget. So I think this is true for all like top pharmas who are successful. Your R&D teams, your BD teams, your wherever you are, they always wish they had more money. And so I think it's a common misnomer that pharmas are flush with cash. You're always looking at your portfolio. You always wish you could do more M&A and licensing deals. And so I think when you look at opportunities like royalty investments, you like them because they offer an alternative to debt or equity. And so I think that's maybe, again, I think we mentioned it earlier, but why it's a great alternative to these options. And so while I can't necessarily comment on the specifics of this question, and I'm sure Clark can, from where I'm sitting, that's why we kind of view them more favorably in this case, especially as it relates, as we mentioned, to the ability to keep it off of our P&L specifically.
So maybe a couple of thoughts here on, tax and structural considerations. The primary tax consideration as a royalty investor is really around withholding tax. So if the royalty is generated out of Japan, for example, and you're a U.S. buyer, is the Japanese government going to withhold tax? And that has to do with very complicated things like the double tax treaty between Japan and the US. And then, of course, it's different between the US and England and the Netherlands and France, et cetera. So the first thing in another iteration of follow the money, it's what that money comes out of Japan and is going to the US, as it would be in our case, is there any withholding tax? And there is actually, as it turns out, in Japan, there's a 5% withholding tax. So you have to take that into consideration because, you're going to get the net amount. Then sometimes there's some fancy footwork you can do to kind of structure that through other jurisdictions like Hong Kong and other various places. That world, by the way, kind of evolves all the time. And so you're kind of constantly trying to figure out, what's going on there. But that's probably the main tax issue, I would say. Um, and on the structural considerations, when you're from an investor standpoint, what there's lots, but the main one that we focused on is around insolvency or bankruptcy risk. And so we're not worried about Daiichi Sankyo going bankrupt, but with an emerging biotech company that's losing money, that's a consideration. So it varies by jurisdiction, and if you have a company in France, for example, that's a different regime than the U.S. And the goal typically of a royalty investor like ourselves is to have it be an asset sale. So that if I'm buying a royalty from a company in France, and the small company in France ultimately goes bankrupt at some point down the road, that the asset that I bought, the royalty that I bought, I get to keep. And it doesn't get swept back into the bankruptcy estate or the insolvency estate in whatever jurisdiction that can be. So it is rather complicated. Of course, Europe is not one jurisdiction, it's 27 different countries, and they all have different legal regimes and different tax regimes. Um, but that's really what we're looking for, is to make sure that we can structure the deal so that we, in a downside scenario, hopefully an extreme downside scenario, that we can continue to collect this royalty. So that's what we're looking at. We actually, France for a long time was very difficult from a legal regime standpoint, but that's gotten better in the last number of years. So we've actually done 2 deals in France this year. We did a deal with a company called GenFit around a rare liver disease product that Ipsen markets globally. And then we just did a financing. We just announced it, I think, a week or so ago, with another French-based company called Nanobiotics, which has a product that J&J is going to be the marketer for. So I think we've done 2 deals in France, like more than anybody else, but that's not saying much, I guess. So these things do evolve over time, and you do have to, keep pace with that. But those are, tax, it's withholding tax. Are you getting the amount of money you thought you were getting and putting in your spreadsheet, or is the government keeping a part of it, and you have to factor that in? And then on the structural side, again, can you structure it as an asset sale so that there's some downside insolvency type event? You can keep
Mhm.
royalty and don't, it doesn't get swept back into the what we would call the bankruptcy estate.
For your portfolio management, like how do you balance the split between not just like the tax or like for in terms of your biotech or pharma balance? Like I'm sure that's part of the discussion in terms of risk management. What does that look like for you guys?
Yeah, it's interesting because there's a split between the counterparty and the marketer.
Oh, interesting.
So just taking, for example, this GenFit deal that I
Right.
mentioned, right? The counterparty to the transaction is GenFit,
Right.
uh, but the marketer is Ipsen, right? Which is a big
Oh, yeah.
global company,
Right.
has a particular, strong
Right.
franchise in liver diseases, amongst some other things.
Yeah.
So what we're looking at most of the time, we're buying from the emerging biotech company, but we're getting paid
Right.
by Daiichi Sankyo, Ipsen,
Right.
GSK, Amgen, whomever.
Right.
70% of the time, 75% of the time, buying from the small company, getting paid by the big company.
Got it.
So from a portfolio construction standpoint, um, you know, we're really focused on the marketing partner and their capabilities around that particular product. So, are they really good at oncology? Are they
Right.
good at liver diseases? Are they
Right.
really good at rare diseases? Is it GSK and they're really good at respiratory, right?
Right.
So, so it's really about the marketer from our standpoint and their capabilities
Okay.
and how that product fits into their portfolio.
Right.
We did a deal this summer where we bought a cardiovascular royalty in a cardiovascular product that Bayer is marketing in Europe.
Right.
Bayer, very good at
Right. Oh,
cardiovascular.
right.
They've actually got a patent expiry coming up here in a couple years. And our view was this new cardiovascular product is going to be really important to them because they need to replace lost revenue that's
Right.
patent.
Right.
Interestingly, the innovator was a company in San Francisco called Bridge Bio who had
Oh,
out-licensed
yeah.
Mm.
in
Yeah.
Europe.
Novartis.
And so we bought part of Bridge's royalty. So now Bayer, pays us the royalty directly. My point is
Right.
is that we're looking at the marketer, what are their incentives, what are their motivations, and that's how we think about it from a portfolio construction. Our overarching mantra,
Hmm.
diversification, right?
Yeah.
And so it's like real estate, it's location,
Yeah.
location,
Right.
location. For us, diversification, diversification.
Yeah.
So we've got 50, I think 55 products in our portfolio. It's in 30 different therapeutic categories. So
Mm.
it's extremely diverse. And I was looking at these statistics yesterday. I think our top 10 products still represent like half or less than half of the portfolio. So we're very diversified. We don't have any, big chunks. Um, and that's really around a portfolio construction
Mhm.
objective to be very diversified. And we know we're going to be wrong about these product
Right.
sales. Sometimes we're wrong because we're too conservative. Sometimes we're wrong because we're too optimistic. But it kind of, if you have a big portfolio,
Mhm.
Right. You'll hit.
you get a little lucky and you do your work. You should be okay. It's hard, but again, the diversification is really what drives our portfolio construction
Right.
uh, objectives.
Wow.
Yeah. So
That's
this,
fascinating.
sorry, there's a perfect transition to the next question, right? So you mentioned right now you really get paid by big pharma with a very strong commercial capability, center disease area, even the innovation come from biotech either Fleet based in France, or like, Bridge Bio based in San Francisco. The obvious question, how about the biotech who give innovation but are based in Asia? Like your Alex represent one of the biggest one. There's a lot of the from China as well, right? Especially for people who are not familiar with what's really going on. China by itself contribute over 40% license deal to big pharma this year as of today. If you plus included Japan and South Korea, are very likely going to be around 50%. That's kind of something you cannot avoid anymore. So I'll probably start with the clerk, right? So you obviously this is coming. How you guys, royalty investor, look at this? What's your play? Then definitely please, Alex, as one of the top Asian biotech slash biopharma, what's your view?
Yeah, so um, our view is we're agnostic as to geography, meaning it's really about the science for us and the quality of the patents and the quality of the license agreement and as I mentioned, the quality of the marketer. So we've done a number of deals that are Japan only, where a US or European company has outlicensed the product to um, Daiichi Sankyo or Mitsubishi, or picked a handful of really good companies there. And so our analysis is really around, again, the patents and the manufacturing, and of course reimbursement is different in each of these geographies. Japan's actually interesting, right? It's more formulaic, as Alex probably knows. And in Japan, the marketer has to provide a projection to the regulatory authorities, sales projection actually. And if they sandbag it and they do a lot more, then there's a sort of mathematical, reduction in price. And so, but that's knowable. And so it's complicated, but it's knowable. And so we're happy to have stuff that's either developed in Japan and out licensed, or developed somewhere else and licensed into Japan. Same thing with South Korea. We're looking at actually a deal in South Korea currently. And Leon, you know this better than most. The technology coming out of China today, as I mentioned before, is really um, uh, quite good. And so I think, again, follow the money. That's kind of a theme, I guess, but follow the money. The big pharmas are licensing technology out of China, and that'll ultimately result in some products that are approved and successful and launched and generating royalties. And so we're looking very closely at China. And one of my colleagues on our research team, Dr. Yichen Wang, recently spent some time, as Leon knows, in China, and wrote a white paper on what's going on there as it relates to biopharma and the implications for royalty investing. And I think we're optimistic, holding aside some of the political noise that's occurring currently. But long term, we think the science matters, quality of the patent matters, again, quality of the marketer matters, and that's really what we focus on. And we're happy to um, own things globally. In our portfolio, about 60% of the sales and royalties are US, about 20% Europe. It's primarily Western Europe. The dollars are really in the big five in Europe. 10% Japan, and a little bit everywhere else. And I think that will evolve over time. Um, um, but things in pharma and healthcare tend to happen on an evolutionary basis, not revolutionary. Things evolve kind of moderately over time. And so we're agnostic. We want to have a slice of the global pharmaceutical sales. And I think if you look at our portfolio, we've been able to construct that.
Yeah, I completely agree. I think there's so much innovation, and I love the point that Clark made about, you follow the science, right? And it's only after that you can follow the money, right? Because great science begets great money, right? And I think there's great nuance in these markets, and we've seen this time and again, in that you have to follow the speed at which this innovation happens, and what follows with this is that you get beautiful signal and beautiful science, and that follows to a clinical, a signal that you then have to see through a regulatory lens, right? And that regulatory lens varies by these markets, especially in Asia, that vary in China and South Korea and Japan. And then you have to have different global commercial strategies within each of these markets. And we know this, especially at Daiichi Sankyo, right? And I think when you then put that in the context of this royalty investment strategy, you have to understand that the royalty has to then follow on that globalization strategy. And so I think what is exciting is that there's opportunity here, but we have to see how that will bear out, in the coming years. But I completely agree in that there's so much to be seen, to see what will come. But I'm very excited. I think Daiichi Sankyo has, and many a pharma peer has put a flag down to say, we're very excited by the science and technology that is coming out of Asia, and has demonstrated itself to not be a fast follower anymore. And I think is going to show itself to be, an innovative, kind of first in class in many a category. And so I think we'll just continue to see not just follow the science, but follow the money that comes shortly after.
Fantastic. Just quick comments, right? So Daiichi, I know you guys, based on the license deal you have with AstraZeneca and Merck, you have a royalty stream, right? You could like consider unload some of them to Clerk, expedite your development. And
Well,
also I
I
learned from you during my dinner, you guys are probably gonna in-license some asset from Asia as well. You could totally do something like what Merck did with the asset in-license from Colon, right? If you get some Asian asset, not from your in-house, but externally. Just a thought.
Oh, I mean, I think it's a wonderful thought. I can't speak to what Merck or AZ or Daiichi Sankyo will do. I
Mhm.
can say that as as an independent opinion, that I am very excited by this
Mhm.
strategy, and I think that Merck demonstrated its willingness to do this type of investment in the deal that it made with Blackstone Life Sciences with its TROP2 ADC. I think that we'll see this continue to be an option that it continues to do, and it's not something that Daiichi Sankyo is aware of this investment strategy. I wouldn't Obviously I work there, so they're aware. We talk about these things, and Daiichi Sankyo has a footprint in China. We have for a number of years, and we continue to spend time there, and
Mhm.
our colleagues at Merck and AZ do as well. So I think it's a great thought, Leon. And I'm
Fantastic.
sure Clark and I, this won't be the last time we speak.
Yeah, yeah. So then let's probably come to our last question. Give a little bit of perspective, look into the future. How do you view the long-term impact of royalty investment? I'm pretty sure it's good, positive to the global biotech industry. So probably start with the curve.
It's a continuation of what we've talked about already, which is more is better. Uh,
Mm,
More innovative products, more clinical solutions for patients. That requires more capital. And so having more options, more alternatives, more tools in the toolbox can only help us speed up the flywheel that I referred to earlier. So um, more is better when you're trying to solve these tough clinical needs, and
hmm
so I think royalties will have an increasingly large role, whether it's funding clinical trials, whether it's funding emerging biotech companies by monetizing their existing royalties and allowing them to redeploy that capital into new products and new development programs. And so, I think the macro trends are really positive in the pharma industry. And if I were to criticize our industry a little bit, I think we don't do a great job as an industry in biopharma talking about all the positives, right?
mm,
All we do is hear about the negatives a lot of which is not true, a lot of which is inaccurate. And so, my view is we should be talking about all the
Hmm.
investment and R&D that's going into these and solving problems. I mean, look at, some of the oncology medicines. Look at, hepatitis C, right? Like basically
Right.
eradicated.
Dedicated.
Yeah.
So it's incredible what's happened, and it's I agree with Alex. It's exciting to be part of this ecosystem, and it's hard. I mean, it's not easy, and but it's exciting because the end goals are so positive and helpful. We all can be doing a better job, I think. Of course, we all could do more and do better. But I think there's a permanent place in the biopharma financing ecosystem for royalty investing in multiple different forms and multiple different flavors. And that again, I've been doing this a long time. I used to have dark hair, now it's all gray. But uh, um, yeah, I actually think we're at the beginning. Again, as I
Mhm.
mentioned, 5 to 10% of all financing is royalty financing, which means there's a lot to go. And in the, sort of American baseball nomenclature, it's not the first inning, but it's like the second or third inning. Uh,
Mm,
so I think there's a lot to go, and it's exciting to be, a small part of.
great. Alex?
Yeah, I mean I love the analogy. We're not starting the game, but we're, maturing into, we're settling into it. And what I like about this funding model is that I think it's a really nice blend of like what is finance and kind of science and strategy kind of perfectly mixing in a new way that allows for like a more global, collaborative environment for speed, to move medicines kind of quicker, for biotech, for pharma, like to work together. And ultimately, I think like at a 30,000-foot view, to Clark's point, is like that serves patients at the end of the day in a better way and allows us, in a community kind of driven way to help move those medicines faster and sooner. And I think that model serves, right, at the end of the day, that goal. And so I like seeing that. I like seeing it be the beginning kind of a transformation and an adoption of this in any way that we can move that. I mean, for me, that's always been the goal. And if we can help innovative science do that better, like let's do more of that. So that excites me. And so I love the conversation. I could talk about this all day, but I think it's been wonderful. I appreciate Clark giving us like really a master class in this. It's been truly educational. So I appreciate very much the opportunity. So thank you so much.
Yeah,
All
likewise.
right.
Thank you.
We do have two questions from the audience. Let's do them real quick because we're on top of ours already. The first question from James. So, how do you think about the potential addressable market size for A, traditional, and B, synthetic royalty? I was about to ask a question, but someone asked this. The traditional real and the synthetic royalty. How do you think about it from the addressable market perspective?
Yeah, so maybe just a quick level set on what those are. These are not things that maybe people are used to hearing. So when I think about traditional royalty monetization, it's my example of GenFit, right? Who was the innovator, developed some technology, out-licensed that to Ipsen. Ipsen now pays royalty back to GenFit. GenFit's looking to raise capital. They monetize, sell that royalty to us or someone that looks like us. So that's how the business started way back when. And that continues to be, at least for us, 65-70% of our investments are those type of investments. What a synthetic royalty is just a recognition that a royalty is just a percentage of net sales, right? That's all it is. And so if the innovator is also the marketer, so for example, we did a deal with a company in Boston called Rhythm Pharmaceuticals. They're in a rare disease and genetic obesity, basically. And they innovated the product themselves, but again, They didn't need 5,000 primary care sales reps to market that product. They need literally like two handfuls of people, and it's more about reimbursement and kind of the full spectrum of services to get the product to the patients. So they were going to market it themselves, and they were capable of, smaller companies capable of marketing it themselves, but they needed to raise capital. Their stock price was under pressure, um, for no apparent good reason, actually, at the time, but this happens. And so we went to Rhythm and we said, well, how about you sell us 10% of your sales, something like that. I don't remember exactly the number, like 10%. And for that, we'll give you $100 million. So that's what's called a synthetic royalty.
Mm.
It's been around for a while. I've done those going back 20 years, actually, but it's become more popular recently, in part because there's now multiple people that will do them. And again, part of this flywheel effect. And so again, it's an opportunity for these emerging biopharma companies, if they're going to launch and market the product themselves, is to sell a part of future revenue. So that's what a synthetic royalty is. The the market size of traditional royalties is a function of how many licenses uh, have been consummated out there, which subset of those products ultimately makes it to the market and therefore generates sales and a royalty that can be sold. That's a gigantic market, um, in a growing market because more in licensing has occurred. The last statistic I saw was 85% of the products sold developed by smaller innovative companies and sold by bigger established companies. That percentage, by the way, has been going up over the last couple of decades. Um, so the market is big and getting bigger. Nonetheless, synthetic royalties, the market is all pharmaceutical sales throughout the globe, right? So it's
Right.
uh,
Right.
gigantic market. What's the issue there is, typically a big pharma company doesn't want to sell a synthetic royalty on their product unless it's part of one of these clinical trial funding
Right.
Mm.
situations, which you're effectively creating a royalty, call it a synthetic royalty, call it whatever you want, in exchange for some capital to fund the trial. So that's an even bigger market. The bar is very high because it's about the science, about the patents, about the regulatory safety situation. And, but then if you're doing a synthetic royalty with a smaller company, you've got to assess their capability and the management team's
Mhm.
capability as a marketer. Can they
Right.
commercialize
Right.
the
Right.
product? Which they may have done in another company, but typically, these small companies, it's their first product typically. And I think on the clinical trial funding side, what you have to assess is, well, was the product actually going to get approved? Which, was not easy to do. So there are different issues, but theoretically, that market is as big as the pharma market. So that's how I would, assuming that's what the person wanted to know in this question, I think it is. That's how we think about market sizing.
Right. 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 So there's actually two more questions real quick. Let's just, we're already past 1 hour mark. The second question, how does the current political environment, as we mentioned, affect our investment allocation, in particularly relate to China versus US-based firm? Royalty with the China firm, I haven't heard any, that's to my knowledge. But anyway, I'll go back to you guys. What's your view on this one?
I think our view is we're in a long-term business. These are 10-year investments, and there's
Mhm.
always some noise around the political environment. That doesn't mean we stick our head in the sand and ignore what's going on. Um, but we're investing for the long haul. Um, and it really is about the science and the patents and the quality of the marketer. And so that's what we stay focused on.
Yeah, I would say like from the pharma side, we've taken like the exact same point of view. Even when it comes to, China and all these other places, like we follow the science and we're on a long-term game. And so we just keep going. But don't bury our heads in the sand, but we just keep following what is So it's refreshing to hear you say that. Same.
Great. This last question, I'm not quite get it, so I'm probably gonna skip this, especially we run over time. But thank you both very much. And also for people who are again new to BioVerse, feel free to scan the QR code. And also, there's two more webinar on in the pipeline. We're probably gonna bunch of more in the future. So please, you can follow us, subscribe our newsletter, follow our website to keep yourself updated about our activity. For those who may want to sponsor us, this is overview. In addition to BioVerse, we also do like weekly newsletter. Asian Biotech is in a bar, and we have a lot of social media platform on LinkedIn, WhatsApp, and WeChat. With that being said, thank you so much, Alex and Clark. Alex rightly pointed out, this is really master class for me. I learned so much, and especially a lot of very insightful and kind of thoughtful discussion and ideas and thoughts. Thank you, and also thank the audience. This is gonna be in replay with our partners based in Asia. Because right now it's like early morning, that's why probably very few people from Asia dialed in. If you want to find the replay, go to our YouTube, or probably you can find our Asia-based platforms. So there's 7 of them. Again, thank you, Alex and Clark. This is my pleasure to have you today. And thank you, everyone, for dialing in today. Bye for now.
All right. Thank you. Yep.
Bye.
Take care.